Hello and welcome to FidelityConnects. I'm Pamela Ritchie. With markets settling into the realities of the end-of-year trade, will next year's theme include watching pretty closely the other so-called 943 stocks in the S&P 500, essentially the broadening trade? This as AI swirls its way through the back offices of corporate North America and indeed through corporations across the globe. Our next guest is perfectly positioned to shine his lens on the markets and the state of play with some of Fidelity's most successful products on the market. He and his team actually designed them. Please welcome Fidelity Director of ETFs, Andrei Bruno, for his end-of-year take. Great to see you again. How are you?
Always great to see you. I'm doing fantastic going into year-end here. It's been an exciting and busy year for all of us, I'm sure.
Kind of an extraordinary year that we're sitting at the end of here after an extraordinary year just before it as well. We'll invite everyone to send their questions in for Andrei over the next half hour or so. Let's begin a little bit with what has led this market. We are going to talk about leadership change and the other 493, but I guess let's first start with the Mag 7, you can argue about the number there a little bit, whether it's a 9 or whatever. Are they too expensive?
So that's a big question that everyone's asking is, are they too expensive? You know, if we rewind back to the start of the year was basically a continuation of the prior year. Right. The Mag 7 was still working, the growth trade, the momentum trade was still working. Then we got the tariff tantrum and everything reversed. What wasn't working was now working and the growth names were no longer working. Then we got a pause and we've kind of continued this momentum growth trade, you know, for the remainder of the year, summer on. If we think about the Mag 7, so a couple things we think about is, you know, does this rhyme with the tech wreck? You know, are there any similarities? Are there dissimilarities? You know, if we look at purely valuations, we're not at, you know, kind of the tech bubble, you know, levels of valuations.
We're in the 30s times things, and that's okay.
That's okay.
Yeah.
You know, relative to historical averages in the S&P, yes, we are elevated. The other thing we also need to appreciate is, if we think back to the tech wreck, there was a lot of companies that were commanding these large valuations that had very poor cash flows, very poor profitability. That is not the case in this. This is not to say we can't get some level of pullback, some level of price to earnings contractions in terms of the valuations metrics, but we do have some confidence in thinking that we're not going to repeat that tech rep as it stands right now. Obviously, things can change for sure. So that's the one thing we look at. But in terms of the next question is like, well, how much longer can we continue this?
Yeah, that seems to be the big one, doesn't it? You know, because as you mentioned, this year was a continuation of last year. So we've been coasting along here with this story.
Yeah. So the question is, and right now, I think, you know, the way I like to look at it is we've got kind of 3 buckets to think about AI. You've got your hardware side, you've got your software side, and then you've got your kind of bricks and mortar side. So, you know, those first 2 buckets is kind of what we're looking at now. Think of like your NVIDIAs of the world, your OpenAIs of the world, the types of companies are creating the software and hardware to support kind of, and that's what the trade's been on right now. You know, the longer term trend, which I find very exciting, is kind of the bricks and mortar AI. So how does it affect that other 493 names within the S&P 500? So the question is, though, when is that going to happen? A lot of people are waiting for it. Is it going to happen now? And that's the $1 million question. I don't know. Maybe we're going to start to see it next year. I mean, anecdotally, I'm sure folks on the line, internally, a lot of people have been talking about AI. How can we implement AI to increase efficiencies? And I think that's what the broader economy is trying to do right now, is how can we utilize this new infrastructure?
But they've been doing that for arguably a couple of years now. Like, they've been training it, trying to figure it out, how it's going to work internally. The question is, I guess, that old accretive question, like, when does it actually kick in as it's helpful for margins ultimately to every other company out there?
Yeah, and again, that's the big question is, and the question is too, is that, you know, at what pace are we going to see it?
Right.
Is it going to be, are we expecting this big jump in productivity? Is it going to be more of a steady as it goes over time? You know, these are the questions that I'm sure many people on the street, many portfolio managers, many CEOs are trying to figure out right now as we speak.
Does it feel like, though, leadership has an opportunity to change? Or to what extent does it feel like leadership could change?
I think over the long term, it certainly can. Because I mean, you think about where the valuations are on some of those, you know, hardware and software names, and where the valuation. If you compare the price to earnings on the S&P 500 cap weighted, you know, we're above historical averages.
Absolutely.
If you compare it to the equal weighted S&P 500, the equal weighted S&P 500 is actually close to historical averages.
Yeah.
So if you think about that discrepancy from a stock market return perspective, over the long run, if we have that switch in regime change or switch in leaders, I think there's a lot of opportunity in the other 493 names.
It's really, really interesting to see how some of that will begin to play out. Let's also talk just a little bit about the risks that are out there. It's an interesting moment. You're ultimately a bond desk guy, but you do a lot of other things at this point. We'll talk about what you're doing now. But when you take a look at credit markets, take a look at sort of the fixed income story right now, credit spreads are very, very tight. Some have said when they're this tight, there's only one direction, and that's wider. I don't know. Where do you fall in sort of the discussion of how healthy the market is right now?
Yeah, I mean,
where it goes.
Yeah, I mean, if you think about corporate credit, so think about credit spreads, your credit risky bonds. As you mentioned, credit spreads are kind of almost at historical tightness right now. So, said in another way, like if you're buying credit right now, you're kind of buying closer to the all-time highs, right?
Right.
So right now, when we take a look at under the hood, defaults, distressed debts, there's nothing that's screaming we've got a credit scenario right now, a credit crisis right now. But it also makes you think about, do I want to buy at the all-time high? If I am buying at the all-time high, like how diversified do I want to be? And I think the answer is you do want to be very diversified across credit right now. Now,
is that a duration story, or that's
so duration's a whole nother story here. So I mean, if you take a look at the short end of the curve, obviously central banks have been cutting rates. We've been seeing rates come lower, but the long end of the curve has been kind of the long end is typically dictated by growth and inflation. So you've actually seen the long end kind of push a little bit higher. Yeah. I mean. If we take a look at GDP forecasts, they're edging a little bit higher, whether you're looking at the United States or even Canada.
Even
Europe. So, I mean, you've got the scenario where you're seeing the low end kind of drift lower and the high end drift a little bit higher. Also, overlay inflation as well, which is, dictates the long end of the curve as well. We're still pushing a little bit hot. In the U.S., we're sitting somewhere around 2.8, 2.7. We get a print, I think, later this week as well. Yeah. Canada, similar around there.
Canada, unless something changes, appears to be at the end of its cycle here. And it could be a hike. I mean, no one's predicting there's going to be a hike soon, but it appears like this is the end of the cycle, is it not?
Well, if you look at the market kind of probabilities for next year, they're pricing in hikes for next year.
Right.
It's not baked in. I think you have to go pretty far out before you even get close to one hike being priced in. I think it's about 75% probability of a hike sometime in Q2, Q3 of next year.
But it's the other direction. It's like, yeah.
It's the hike. In the U.S., they're still pricing in a couple more cuts, but they're a little bit higher. When we think about interest rate differentials across the globe, U.S. rates are still quite high relative to the rest of the globe. Whereas Canada, obviously, we're much lower than them, which obviously has implications for currencies as well, which will be another interesting story for next year.
So let's go there. When we can go briefly into sort of the positioning story, but one of the big question marks for any investor really across the globe is the U.S. dollar and the discussion of moving away from the so-called U.S. exceptionalism to diversify, essentially. And maybe just talk about that as it relates to currency, the U.S. dollar itself.
Yeah. So obviously, all the tariff implications are, broadly speaking, negative for U.S. dollar considerations. What's kind of partly offsetting that is how high their rates are relative to the rest of the world. Obviously, equity markets are doing quite well as well. So, flow of financial capital is still funneling into the United States. I think when we think about the U.S. next year, and to take a step back too, we think broadly about currency cycles as well.
Right.
Historically speaking, the U.S. dollar cycle has been around 15 to 17 years, where you see kind of this big trend and down and then backing up. So we're kind of on the leg of, if we're thinking purely technical and looking at charts and of history,
time, in a way.
We're kind of on that downward slope of kind of U.S. dollar weakness there. But again, I think for next year, we saw quite a bit of depreciation on the U.S. dollar versus kind of the remaining G10 currencies. I think on a balance for next year, I think we could see kind of a continuation of that, but maybe not to the degree that we saw it this year. But again, those interest rate differentials are obviously going to play. The carry trade obviously comes up quite a bit as well. So right now, if you think about the carry trade, ultimately the carry trade just 101 is you borrow in low interest rate currencies and you invest in higher rate. Right now, the U.S. is relatively higher than the interest from our interest rate is relatively higher, whereas you have a lot of funding currencies that are relatively lower. What'll be interesting, obviously, is Japan as well, which has historically been a big carry trade currency, with the possibility of the Bank of Japan potentially raising interest rates.
Yeah. It's generational, literally.
Very generational.
Along with sort of the currency implications in that story, what do you see? So April happened, and we saw a changeover of perhaps international investors coming out of the US dollar, then lots of flows right back in and caught this amazing rest of the year trade. Just sort of speak to how it works with funds who rebalance around at year end. I don't know when that all happens, but if there are those international investors, even US investors, Canadian investors, who might just hold out until year end before they make decisions, what will a depreciating US dollar, if you believe that's what it is, mean for sort of this moment, literally at year end, as things turn over for a lot of funds?
Yeah, well, one other quick thing, I want to take a quick sidebar, is the other thing as well is you're seeing a lot of central banks diversify away from the US dollar, which is placing some pressure on the US dollar. So, and that ties into the gold trade as well.
It does, yeah.
You're seeing a lot of central banks, and the way they're diversifying away from the US dollar is buying gold. Mm-hmm. And obviously, gold has had a generational run this year as well. So that's a longer term trend that we're seeing with central banks. Again, if you rewound back to the early aughts, it was the opposite. Central banks were selling gold. I think, I can't remember the exact year, but I think Canada sold off all its gold reserves sometime in the aughts. Mm-hmm. You're seeing a bit of a reversal of that trend. So that's obviously weighing on the US dollar and also helping to support the gold trade. In terms of year end, in terms of hedging under the hood, there's usually, if you have hedged products, just a little bit of mechanics here, is typically at year end, you will see a lot of hedging. And usually how that happens, if US equity markets go up, you need to hedge more because now the value of your US dollars in your portfolio have gone up. So generally, thinking back to my FX days, is whenever you saw a really strong run in US equity markets, you typically saw US selling at the back, right? Because now the value of your hedge is here, but the value of your equity has gone up. You have to overlay some more hedges.
So could that happen over the course of a year end? There are lots of decisions that they're not always made now, but some of them are. Yeah,
and then there's also the active side of it is people thinking about, should I be hedging? Should I go more into currency neutral?
We hear that a lot, the currency neutral discussion now.
Well, we didn't have that discussion for 5-6 years, and it certainly has cropped up more this year with people looking to take some US dollar exposure off the table. I think you'll continue to see that trend as we go into 2026.
Do you think it will be somewhat slow and steady, or gosh, it's year end, there's some real rotation? What's your general sense?
I doubt you'll see, typically people don't want to make too big of moves going, especially this late in the year now, back to last 2 weeks of the year, people don't want to do anything too drastic, don't want to move too much around. Liquidity is a little bit thin.
Let's talk a bit about that. This is that moment, isn't it?
So, as we get into the back half of the year, liquidity, regardless you're looking at, fixed income markets or equity markets, mm-hmm. You see liquidity get a little bit dry. People don't want to hold as much risk going into year end. So there's always a word of caution, trying to, next week we're going into the holidays there. You typically don't want to move too much around that week. Liquidity can be low, prices can be a little worse than you'd otherwise expect. So there's always a word of caution. Exactly. FX markets are a little bit different. They're super, I don't know what the number is now, but $4 or $5 trillion are traded, daily in FX markets. So it's an insanely deep and liquid market, particularly around the US dollar, of course, as well.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Mm-hmm. Okay, that's fascinating to go into that. I wonder, some of the discussion of how people can diversify and change a bit how they're allocated comes a bit from different products that are available. Your team, let's go into what your team does exactly. As I sort of mentioned, you come from the bond desk, from FX, but at Fidelity, you create some of the products that go out there, and then you make sure you're a huge liaison. What is your job exactly? So we can talk about how clients can diversify.
Yeah, so my job on my desk, what we essentially do is we deal with product development, particularly around our ETFs. So, we keep our finger on the pulse on what's happening in the ETF market. What kind of products are we seeing coming out? Where are there gaps in the overall market? Where are the gaps in our own lineup? And how can we bring kind of the best-in-class solutions to market to meet those needs, whether it's our investors, whether it's rounding out our particular lineup. So there's a lot of kind of research and analysis that goes into our day and day. And that's kind of one silo of the world that I operate in. The other silo is kind of on the ETF capital markets side as well. And there we're dealing with any of the idiosyncrasies around how ETFs trade, relative. Obviously, mutual funds, you put in your order, it gets filled at 4 p.m. NAV. ETFs trade like stocks intraday. So we work, very closely with the market makers on Bay Street. So those are the folks who are making markets in our ETF daily, making sure they're getting all the necessary information on a daily basis so that they can accurately price our ETFs on a daily basis. So investors can come to market and know that they're getting execution prices that are close to what we call the intraday NAV of our ETF. Another part of our job is to try to keep them honest as well, making sure that they're appropriately pricing, providing liquidity to our end clients so that they can have a smooth experience when they're trading our ETFs in the secondary market.
That's fascinating. So are you actually sort of picking up the phone and checking in with people across the market maker universe, but also other parts as well? You're a connector there.
Yeah, so we can see on our screens where our ETFs are trading. We do have some kind of internal models where we, try to estimate where our ETFs should trade. So we kind of use that as a bellwether to keep, kind of the market makers honest. And for the most part, they do a fantastic job. Yeah. We obviously do analysis, making sure we take a look at big block trades. We see, was that priced reasonably? Because ultimately, again, our end clients are our investors, our financial advisors who work closely with us and have given us trust. And we want to make sure that they're having a good experience in the market and, paying as little as possible in terms of a bid offer spread.
And just sort of make sure that, everything's filled appropriately and so on. It's a bit of, I'm sure lots of good companies do this, but it's a little bit of a why Fidelity to make sure that you have such a strong team doing that around the clock, pretty much.
Yeah, exactly. When markets are open, like there's a team, myself, and there's two on the ETF capital market side. So we're pretty dialed into what's happening all day. We're consistently watching. We have a number of alerts set up. If we see wild moves in our ETFs, we investigate, make sure the market's operating appropriately. There's nothing wonky going on. We see if there's large blocks printed, we take a review of that and, making sure that everything was priced, at least, reasonably for current market conditions. So we take it very seriously and we do stay on top of it. We do retroactive quarterly reviews as well as of our volumes of large blocks that were printed to make sure that, again, that everything's operating as it should in the secondary market.
It's totally fascinating how that all connects in together. So some of the products that we've spoken to you and your colleagues about help everyone take a look at diversifying across regions, across various different asset classes. Let's talk a little bit about the regional story from this year. One of the other huge stories which does not connect to 2024 in the way that perhaps the Mag 7 did is the international trade and how that has taken off this year for kind of a variety of different reasons, but has certainly, I think, surprised a number of people of how well that's done. The question is really, does it have legs to go further?
Yeah, so it's the first year we've seen this trend in quite some time. If we were going back the last 3, 4, or 5 years, U.S. equities is where we've seen, and thinking particularly I'm using the ETF market as a proxy, I know those numbers quite intimately. But on the equity side of the ledger, it's been international equities have garnered more flows than U.S. equities and Canadian equities. And that started probably somewhere around kind of the tariff tantrum time when we saw that shift. And then, we figured once we got that pause, we said maybe this trend will reverse. We haven't seen it reverse. International equities have continued to garner more flows than U.S. equities. And I think there's a couple factors at play there. Number one, a diversification play. People have been overweight, U.S. the growth names for quite some time. It's a way to diversify geographically, kind of away from the U.S. a little bit to some degree. Take some risk off with regards to those Mag 7 names. And then number two, there's the valuation play as well. Obviously, European equities or even international equities, broadly speaking, are trading a lot closer to their historic averages relative to, say, the S&P 500. So I think those two factors are at play. A third factor as well is kind of where, think about Europe and international, is where they are kind of the economic cycle as well.
They're more like Canada in the sense that their interest rates were cut earlier and harder and faster.
Exactly. So the thought is they're kind of a little bit further along and, maybe seeing glimpses of light at the end of the tunnel. So potential some opportunities there from an international perspective.
And so, because that's happened, and for instance, interest rates being cut does take some time to filter through. You expect that to carry on, or?
I mean, you would assume it would be stimulative to, but to your point, it takes anywhere between 6 and 18 months for monetary policy to kind of find its way into the broader economy. So, from a monetary policy perspective, they're certainly decently positioned. You'd think it would be stimulative. There's obviously some structural factors, thinking about Europe that are still at play there. If we think about China, there's, still
China is one of their main clients,
there.
And the consumer story out of China is not as good as it was.
No, I mean, the recent consumer numbers, I think consumer demand has taken a dip most recently. So there are still some, I think they're projected to grow at 4.5%, which I think historically, we think back to the 2000s, even the teens, it was, we got to hit we have to hit that 6%, greater than that 6% number. So we are trending a little bit lower, but it's also somewhat expected as the Chinese economy fundamentally changes as well. If we think back to the early 2000s, there was no middle class really. The middle class is certainly starting to grow. So you are seeing kind of a real-time shift from that, manufacturing economy to more of a consumption economy.
Yeah, that's really interesting. But what about sort of the EM story? Because it's also had a pretty fantastic year in terms of diversification again.
Yeah, certainly EM is also another area where we haven't been looking too closely in the last few years. I think we think back to, I believe it was 2021, there was that whole real estate issue in China. Yes. Which obviously affects broad market EM indices, because I think it's like 40 to 50% of the EM indice. We can have a philosophical debate whether China's an emerging market or not. It still is classified technically as one. But EM certainly starting to get a little bit more interesting. Obviously, the weakening US dollar helps funding situations for EMs. We thought back, there was a few years back where US dollar was really kind of strengthening up relative to EM. That's generally not positive for emerging markets. So certainly there is somewhat of a tailwind there from a currency perspective alone. But it is certainly an area that's going to be more interesting moving forward. It's been somewhat ignored for the last several years. But it'll be more of an interesting story, I'd say, for 2026.
You mentioned off the top that AI, its effect on large companies in the US, for some of the story we're talking about it in terms of sort of leadership change, if it can filter through 493 other companies and be kind of accretive and useful to margins and so on. Can that same situation not take place in Europe? Is it built into the base case for why equities actually all over the world, like even EM? To what extent is that one of the next questions?
It's certainly more obvious to me for developed markets that are more knowledge-based economies. The EM is an interesting one. I tried to think you it.
If they can leapfrog, right?
That's the question.
Can you?
That's the question is, I mean, if you think from a manufacturing perspective, long term, the question is, does AI create a lot of that manufacturing? Do we bring some of that manufacturing back home? Because now it's AI, there's machines, there's robots, and this is a longer term trend. It's not. I don't think this is happening tomorrow.
It's happening every year.
So the question is do they lose? Does EM lose from that perspective, or even textiles manufacturing, for example? So some of those more industries that we've offshored over the last 20, 30 years and seek of cheaper labor markets. Does that hurt EM, and does that come back to North America? Does that come back to Europe? I don't know. And then the other question, your point is do they make educational systems and having the right people in order to run certain companies is obviously very important. Can they leapfrog that now with AI and saying, we don't necessarily need all these people who have all these specialty expertise. We have AI who can do that.
Right.
So
can it advance an economy and companies within just maybe without a degree in whatever.
I guess the real question is relative to some of these developing markets.
Exactly.
Are they going to do better? Are they going to do the same? Are they going to do worse? I don't have an answer to that question just yet, but it is certainly one that I think will be answered over the next 10, 15 years.
We've done a lot on regional, which I think is really interesting because it's one of the fascinating sort of changes this year. What about in styles? So you go from sort of the U.S. growth discussion, which ties in U.S. exceptionalism, to other types of styles, even taking a look at different factors as well. These tie, again, into the ETFs, and many of which are offered here. But what about style diversification?
Yeah, so the first place I like to start in terms of styles is where are we in the economic cycle?
Okay.
And
yes, where are we, Andrei?
I mean,
honestly,
we think we're in late stage,
right.
But then we, increase growth forecasts, and then maybe you say, for example, last time, a few years back, we were like, we're in late, and then we're like, oh, I think we're kicked back into, mid-stage again. Yeah. So right now we're in late. I'll say that with our best guess.
Because there's some who say out of April, we're in early. But, it's just another voice.
Exactly. So, historically, and certainly when you look at factor returns, it's not obvious either.
Right.
As, historically and late, you've wanted to look at kind of momentum as well as quality. Those have been kind of what has outperformed historically in late stage. What we've seen this year, we've certainly seen momentum outperform. We haven't seen quality. It's been value has actually done better than quality. Which is interesting because you wouldn't expect those two to be working at the same time. But I also think that's more of a diversification play. Money is flowing. I'm trying to think, how can I, we talked about geographically diversifying. There's also factor diversification. And one of the lower correlated with growth is obviously value. So I think you've seen some investors take some chips off the growth value story or the growth story table and put it into value just as a means of diversification.
That's really interesting. And so that may be a bit of a trend going forward. I mean, do you see that sort of going into 2026?
I think as long as people are, remain to be not, I shouldn't say uneasy with regards to the growth story, but, thinking, maybe I need to diversify a little bit. Maybe there's a possibility that we do see a bit of a pullback on some of these names. I think you'll continue to see folks potentially look at kind of value as a diversifier against their growth names in their portfolio. Let's
do a quick roundup. We just have a couple of minutes left. There's a couple of different questions here, but one has to do with US GDP, earnings versus Canada. I wonder if just broadly we can ask you about, there's going to be a bit of a data dump this week, like a deluge of, we've got jobs in the US coming out, lots of it related to the shutdown and weird times for things to be released. But ultimately they tie into, central bank policy. So just give us a little bit of an outlay of what you think data coming out over the next little while might mean to warp.
Yeah.
What might we see in terms of expectations?
So I think in the U.S., just a reminder, the U.S. has a dual mandate in terms of their Fed. They've got an employment mandate, maximize employment, as well as a 2% inflation target. So obviously those are the two big numbers you want to look at with regards to Fed policy. Now inflation is running above their target, whether you're looking at CPI, core CPI, PCE, whatever metric you're looking at, it's running in the high twos. And then the other side of the coin is the employment story. So employment has deteriorated a little bit this year. And again, we were talking about this before, we were talking about this back in the summer, and we thought maybe they were seeing some data we weren't, and that there was going to be a big deterioration in the labor market. We haven't seen a massive deterioration in the labor market. It's
there were some big revisions.
There were big revisions, but the headline number, if you look at it, in unemployment, it's still reasonable. They have ticked higher throughout the year. The question is can they hang their hat on the employment side and say we need to continue to cut, or do they start placing more focus on kind of the inflation side? If we take a look at the last meeting, there were 3 dissenters, although one of the dissenters said we should actually cut more. Yeah. So we're going to focus on the other 2 dissenters who said we should stand pat. And then if we also take a look at some of the other Fed members, non-voting members, they were also similarly, there were a few of them who were also in the similar camp of maybe we need to put things on hold.
Because there could be inflation that still needs to be worried about.
That's just that. And for Canada, we've cut a lot. We're hanging, at the higher 2s as well here in Canada, but we've got a 1 to 3% band.
And we're in it.
So we're still in it right now. That being said, markets in Canada are pricing potential for hikes next year, which, could put us in a bad spot, to be perfectly honest. GDP's getting revised a little bit higher. The question is, is it still going to be strong enough to support, theoretically, we could support, a little bit higher interest rates, but I think the Bank of Canada probably wants to stand pat where they are right now.
So diversification seems to be the message. What's the most interesting sort of piece of the economy, the capital market story that you might just point us in the direction of just keeping an eye on next year?
Yeah, so for
there's
next
lots
year,
of them. But
I mean, for me personally, and this is kind of, headline stuff, but I'm very interested with the AI story still.
Okay.
Like I'm from a short-term and a long-term perspective. Me personally, I think long-term, I think it will be kind of another industrial revolution for the overall economy. So that's something I'm looking at, and everyone and their mother is obviously looking at as well. But that's what continues to interest me, because I'm thinking more longer term and the implications it will have on the broader economy. And I think it's a tremendous area for growth and productivity gains for the global economy over the next 10, 15, 20 years. So it's really exciting for me.
So exciting to get your views, the year-end views. Andrei Bruno, thank you for joining us. Have a great holiday when you get there.
Thank you. Same to you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.